Imagine this. You wake up tomorrow morning, log into your brokerage account, and your net worth has quietly jumped by $200,000 overnight. Not because you bought some meme stock, not because you started a new business, but because of one decision you made years ago. A decision that now lets you buy assets with what feels like free money, while other people are still clipping coupons and trying to pay off their credit cards as fast as possible. Now, pause for a second and be brutally honest with yourself. Have you ever felt like the game of money is rigged? Like no matter how hard you work, there's this invisible ceiling, while a tiny group of people somehow keep getting richer even when the market crashes, even when they lose on paper, even when they never seem to sell anything. Here's the uncomfortable truth most people never hear. The wealthy are not playing the same game as you. They don't treat debt as a trap to escape. They treat it as a tool to multiply their wealth. And the strategy that turbocharges this is something called debt recycling, tied together with a mindset known as buy, borrow, die. It's the closest thing you'll ever see to legally buying assets for free. So in this video, you're going to see exactly how that game works. You'll see how billionaires live insanely rich lives without selling their assets. You'll see how they borrow against their wealth, often at lower tax and lower risk than the average person with a car loan. And more importantly, you'll see how a simplified version of this can be adapted by a normal person in a normal job without needing to be a tech founder or a hedge fund manager. But before we get into the mechanics, let's start with a story. There are two neighbors, Sarah and Mark. They live in similar houses, in a similar neighborhood, earn roughly the same income, and even bought their homes at roughly the same price. On paper, they look identical, but 10 years from now, their financial lives could not be more different. Sarah does what almost every financial guru tells her to do. She attacks her mortgage like it's the enemy. Every spare dollar goes into paying down that loan. She drives a modest car, skips vacations, and every time she thinks about borrowing money, she hears that voice in her head. Debt is bad. Get rid of it. Mark does something that, at first, looks reckless. He doesn't just pay off debt, he recycles it. Whenever his home goes up in value, he doesn't just sit there and clap. He calls the bank and asks for more debt. Crazy, right? Here's what he actually does. Over time, Mark's house appreciates. Maybe he bought it for $300,000, and a few years later, it's worth $450,000. Instead of celebrating and moving on, he taps that increased equity. He refinances or takes a line of credit against the property. The bank, happy to lend against a solid asset, gives him access to, say, $80,000. Most people, if they do this at all, blow that money on a kitchen renovation, a car upgrade, or a vacation. That's how debt becomes a trap. Mark does something different. He uses that borrowed money not to consume, but to buy assets. Maybe he buys dividend-paying stocks. Maybe he buys a small rental property. Maybe he funds a boring, cash-flowing business. The key is that he uses debt, money that isn't his, to buy things that throw off cash and can grow in value. That is debt recycling in its simplest form. You take money that would normally be locked inside something dead, like equity in your home or a fully paid-off asset, and you recycle that equity into new, income-producing assets. You keep the good part of debt, leverage, and avoid the bad part, consumer spending. Now, here's where this gets wild. Fast forward 10 years. Sarah has almost completely paid down her mortgage. She owns her home free and clear, and people applaud her for being debt-free. But her wealth is mostly trapped in that house. If she wants to access it, she either needs to sell her home and start over, or go into debt for the first time in decades, which terrifies her. Mark, on the other hand, still has a mortgage. In fact, he's pulled equity out multiple times. On paper, he has more debt than Sarah. But he also has multiple streams of income, rental properties paying him every month, a portfolio that has grown because it was funded with borrowed money. The question is, who is actually safer? The person with a fully paid-off house but no meaningful income-producing assets? Or the person with debt but layers of cash flow, tax advantages, and assets that can support that debt? That tiny mental shift from debt is evil to debt is a tool if used against assets, not toys, is exactly how the wealthy separate themselves from everyone else. And when you zoom out to the billionaire level, this same idea mutates into something even more controversial. Buy, borrow, die. Let's walk through it. Phase 1. Buy. The wealthy spend years, even decades, buying and building assets that grow in value. Think stocks in their own company, major stakes in businesses, real estate portfolios, or broad stock market holdings. They are not obsessing over being debt-free in their 30s. They're obsessing over owning things that compound over time. Imagine someone like a tech founder. On paper, this person might be worth hundreds of millions, even billions, because of the shares they hold in their company. But those shares are mostly just numbers. There aren't cash in the bank. So how does that person live in a $20 million home, fly private, and fund a lavish lifestyle without dumping all their shares on the market? That leads to phase 2, borrow. Instead of selling their assets, they walk into a private bank and say, "Hey, I own $200 million of this stock. I don't want to sell it, but I'd like to borrow against it." The bank loves this. To them, this is some of the safest lending they can do. The asset is highly valuable, the borrower is wealthy, connected, and has multiple backstops, so they offer a low-interest loan secured by those assets, known as a securities-based loan, a line of credit, or margin loan, depending on the structure. Now, here's the key. That loan is not income. If structured correctly, it's just debt. In many tax systems, that means it is not taxed the way a paycheck or capital gains from selling stock would be. So this person is living off borrowed money, effectively consuming today against the future value of their assets without triggering a massive tax bill. Think about that difference for a second. You, as a normal person, work 40 to 60 hours a week. You get a paycheck. That paycheck is taxed before you even see it. Then, if you invest and make a profit, that profit is taxed again when you sell. The ultra-wealthy, they buy assets. Those assets go up. Instead of selling them and paying tax, they borrow against them. They get cash in their account, they live off that borrowed money, and the tax bill, often far lower or delayed for decades. So what about phase 3? Die. This is where the strategy goes from clever to almost unbelievable. When that wealthy person eventually dies, in many systems there are rules around what happens to their assets. In the United States, for example, there has historically been something called a step-up in basis, which means that when assets pass to heirs, the tax basis can reset to the market value at death. That can wipe out a huge amount of unrealized capital gains for tax purposes. Translated into plain language, if a billionaire bought stock for $10 million that's now worth $200 million and they never sold it, the built-in gain is enormous. But when they die, their heirs can inherit those shares as if they bought them at $200 million. That $190 million gain may never get taxed the way it would have if the billionaire had sold during their lifetime. So what happened over their lifetime? They bought, building up assets. They borrowed, living off those assets without selling. They died, and the tax system often resets the board for the next generation. Buy, borrow, die. Meanwhile, the loans they took, those can be paid off using a portion of the estate, while the rest of the assets continue forward with the heirs. The debt was simply the tool that unlocked a lifetime of spending without triggering taxes the way constant selling would have. And this is where you might be thinking, okay, cool, but I'm not a billionaire with a private banker. What does this have to do with me? This is where the idea of debt recycling becomes powerful for normal people. You're not going to copy the exact buy, borrow, die playbook at billionaire scale, but you can copy the mindset. Stop seeing debt only as a prison. Start seeing it as a lever, if and only if it's attached to assets that pay you back. Let's build a mini version of this in your life. Imagine you own a home. You've been paying the mortgage for years. Your property value has gone up. Most people just feel safer when they see that their loan balance is lower. But your equity, that gap between what your home is worth and what you owe, is just sitting there, doing nothing. Debt recycling says, what if I could pull some of that lazy equity out and put it to work? So you talk to your bank about a home equity line of credit or a refinance. You don't max it out, you don't go crazy, but you access, say, $40,000 of that equity. Now you have a choice. Option A, new car, new kitchen, 3 luxury vacations. Option B, down payment on a rental property, a portfolio of boring dividend stocks, or a small online business that generates cash every month. Option A gives you memories and Instagram photos. Option B gives you cash flow. Debt recycling chooses option B over and over and over again. Here's where it starts to feel like free assets. The new asset you buy, let's say a rental property, starts generating rent. Part of that rent goes to cover the new debt you just took on. Part of it goes into your pocket. Over time, the property itself may rise in value, so you used borrowed money, backed by your home, to buy another asset that brings in money and grows. Now the equity in asset number 2 starts growing. What do you do when that happens? You guessed it, you can recycle again. You pull some equity out of the rental or out of your primary home again as values grow, and you use it to buy asset number 3. You're still being careful, you're watching your cash flow, you're not over-leveraging, but you flipped the script. Instead of spending your whole life trying to have zero debt, you're structuring your life so that every dollar of debt is tied to something that pays, grows, or both. This is exactly the opposite of how most people live. Most people take on debt to buy things that drop in value the moment they swipe the card, then spend years working to pay off that debt with after-tax income just to get back to zero. The wealthy buy assets, those assets go up. Instead of selling them and paying tax, they borrow against them. They get cash in their account, they live off that borrowed money, and the tax bill, often far lower or delayed for decades. Now, here's our special reality check. Leverage cuts both ways. If you borrow to buy assets and those assets crash, you don't just lose your upside, you can be forced to sell at the worst possible time. This is especially true with things like margin loans on stock, where lenders can force a liquidation if values drop too far. Second, cash flow is everything. Debt recycling only works when the assets you buy can reasonably cover the cost of the debt or be supported by your income without strangling you. If your new assets aren't producing cash, you're just stacking risk. Third, time matters. Buy, borrow, die works over decades. Debt recycling is most powerful when done patiently through multiple market cycles, not as a get-rich-in-12 months hack. But if you approach it like a casino, you'll get casino results. But if you combine discipline, time, and smart leverage, the effect can feel almost magical from the outside. Think about this. 2 families start with the same income. They even buy similar homes. Family A spends 30 years trying to be totally debt-free. Family B spends 30 years trying to be strategically debt-positive, always tying debt to assets, recycling equity, and letting cash flow pay down loans. At the end of those 30 years, Family A might have a paid-off house and a modest retirement account. Family B might have a bigger mortgage, but also 3 rental properties, a portfolio of income-producing investments, and a far larger net worth. On paper, Family B has more debt. In reality, they have more control, more cash flow, and more options. And that's the real punchline. Wealth isn't just about being safe, it's about having options. Debt used on liabilities removes options. Debt used on assets creates options. So what could this look like for you starting from where you are right now? Step 1, audit your debt. List out every loan you have: mortgage, student loans, car loans, credit cards, personal loans. Then separate them into 2 buckets: debt tied to assets that have at least a chance of going up or producing income, and debt tied to things that are just gone: the trip, the gadget, the impulse buy. Your first mission is simple: aggressively eliminate the bad debt. That's the credit cards, the high-interest personal loans, the car debt you regret. You can't play the wealthy person's game while drowning in 25% interest. Step 2, strengthen your foundation. Build a small emergency fund so you're not constantly one broken appliance away from panic. Without a cushion, every fluctuation in your assets will feel like a crisis. Step 3, decide which good debt can be recycled. If you own a home and have built equity, just explore what your options are. Could you access some of it at a reasonable interest rate? Could you handle the payment if your new investment took time to show results? Step 4, get brutally honest about your skill set. Are you someone who understands real estate deeply? Are you more comfortable with stock market investing? Do you have the ability to build or buy a small business? Debt recycling only works if the asset you buy is something you understand well enough to manage through ups and downs. Step 5, start small. Your first recycled dollar doesn't have to go into some huge flashy deal. It might be a small rental, a boring index fund strategy, or a tiny business acquisition. The point is to build the muscle of using debt to buy assets, not to inflate your lifestyle. And as your assets grow, you can gradually increase the size of your moves. You're not going from zero to billionaire buy, borrow, die mode overnight, but you are stepping into the same pattern. Own assets, borrow strategically, let time and compounding do the heavy lifting. Now, here's where this ties back into the emotional part of money that nobody talks about. Debt is scary because most people have only experienced it as pain. The late fees, the collections calls, the feeling of sending half your paycheck to some faceless lender every month and still seeing the balance barely move. So when you hear use debt as a tool, your brain goes, nope, I've seen this movie before. But what if the problem wasn't debt itself? What if the problem was what you were buying with it? Because here's the secret. Billionaires are scared too. They feel risk, they see markets crash, but they build systems around their debt. They work with teams who monitor their risk, they over-collateralize loans, keep liquidity on the side, and diversify income streams. You don't need a private banker to copy that mindset on a smaller scale. You can decide, I will only borrow against things I understand. I will only borrow when I have a realistic path for the asset to cover the cost. I will never use recycled debt to flex for other people. That is the line between using debt as a trap and using debt as a tool. So when you hear buy, borrow, die, don't just think of some billionaire tax trick. Think of it as a blunt reminder that the rules of money are not fair, but they are knowable. And once you understand them, you can start bending them, even just a little, in your favor. Because here's the alternative. You keep playing the old game. Work harder, save what's left, pay off all your debt, avoid all leverage, and hope that a lifetime of playing it safe will magically turn into freedom. But look around. Most people who follow that script end up with just enough to not be poor, and not nearly enough to feel truly free. The wealthy didn't get there by accident. They got there by ignoring a lot of the traditional advice that says never touch debt, and instead asking a better question. How can I make every dollar I borrow work harder than every dollar I earn? So when you finish this video, ask yourself two things. First, where in my life is debt currently a trap, and how fast can I shut that trap? That might mean cutting up a card, selling an unnecessary car, or downsizing something that's quietly draining your future. Second, if I could only use debt to buy assets, what would I buy? Real estate? A business? A portfolio of investments? Skills that increase your earning power? Because once you answer that second question clearly, once you know exactly which assets you trust, understand, and are willing to hold for years, then debt stops being this vague, scary monster in the background. It becomes what the wealthy already see it as, a focused, deliberate tool. And that's the real plot twist of this entire strategy. Debt is not the villain. Debt is the side character. The real star of the story is what you buy with it. The wealthy use debt to buy assets, then let time, cash flow, and the tax code do the heavy lifting. Everyone else uses debt to buy a lifestyle, then uses their time and energy to dig out of the hole. You don't have to be a billionaire to change which side of that line you're on. You just have to decide that from this moment forward, every major debt decision in your life will pass a simple test. Does this make me look rich today, or make me actually rich tomorrow? Answer that honestly, and you'll know exactly when debt is a trap and when it's the most powerful tool you'll ever use.